are expecting maybe 2025 Brazilian and European audits may yeah, come for audit. That is our expectation. Now the current situation of the company is now running smoothly, but there is a tremendous pressure from the market situations and dynamics. The pressure on the selling prices, which are though the quantities are manufactured more, but because of the sales prices pressure, turnover is not increasing at this moment. But we are expected to grow when the regulatory market will come into the in hand. So now we have our R&D facilities are also working very hard, and we already commercialized, as we promised last year, 3 new molecules like dapagliflozin, ticagrelor, and apexaban. So ticagrelor is already commercial in quantity in metric tons, and the dapagliflozin also is commercialized in sales started in few hundred kilos like. And apexaban is under qualification. Maybe we are expecting next quarter some customers will also expect to get the orders, and we have already qualified. Our facilities are already audited by the customers, and things are moving on. And we are, in addition to that, we are also planning to go for a backward integration of all the new molecules, which are some imports from China and other places, which we want to manufacture our own. Already our team of people are capable to develop, and also in some products already developed, but in fine tuning, and also we have to go for some commercial. One of the products of ticagrelor already we are commercialized, and now batches are taking place in one of our unit 1, where this product we used to import from China with high price, and now we are capable of making our own. And also apart from our own consumption, we are planning to supply to other customers as well this intermediate, which is one of the good intermediate we have developed and successfully. So I am confident of promoting this molecule also. Even we are getting inquiry from China as well. So this is one of the major. Now I think 2025 is our main focus for regulatory market: Brazil, Argentina, China, Korea, China, and European. So this is our direction which we are going ahead, and I hope we will do our best, and we need your support all the time. Thank you very much.
Thank you, sir. Your company has availed the facility of CDSL for convening AGM through video conference.
5th AGM. FY24 was a tough year. We saw a reduction in revenue, tremendous pressure on the margin, and a quarter of loss as well. We have touched upon these critical issues in the annual report. I will try to shed some more light on the performance of FY24 and the road ahead. Just to recap, the absolute volume growth across all products was 17% in FY24, with individual product volume growth ranging between 5 and 25% for different products. In contrast, price reduced by 10 to 30% in various products, resulting in a net lower revenue. If even at constant prices, our turnover should have been at least 150 crores, but it was not. Such is the competitive landscape in the API industry, particularly in the domestic and rest of the world markets that we operate in. These are primarily spot price driven markets as opposed to more regulated markets such as Europe and US, which are more long-term contracts based markets based on fixed prices and committed volumes. We have received a host of questions from our shareholders regarding various aspects of the business, and I thank you for the same. It gives us that extra boost to work that much harder, and gives us the confidence that the shareholders place in us. Before I get to the questions, I would like to recap the broad steps of our strategy so far. Number one was focusing on R&D to develop new APIs and products, expand market access by filing drug master files or DMFs in key high-value markets such as Europe, Brazil, China, and South Korea, backward integration to reduce cost and be competitive. Although we have been successful in executing some of these strategic initiatives, there have been some setbacks as well. For instance, we have developed several new processes to achieve backward integration, but expansion of market access has been slower than anticipated. I will touch upon the progress of each of these strategic initiatives. Number one, market access. As you are all aware, DMF filing or drug master file and GMP inspections are key to market access. We have filed multiple DMFs in our focus markets, but have underestimated the timelines required by the regulatory bodies to grant approval. Till March 2024, we have filed one DMF in EU, two in Brazil, South Korea, and China each, which brings our tally to 7 DMFs in these key markets as on today. However, given the current regulatory environment, limited resources of the regulators, and backlogs due to COVID pandemic, our files are moving slower than anticipated. Number two, backward integration. In FY24, R&D majorly focused on cost reduction and backward integration, which helped us tide a challenging year with little damage. This focus on backward integration was very crucial for sustaining our competitive edge. R&D efforts in improving product costing played a very significant, very important role in maintaining margins last year. Therefore, no new APIs could be commercialized in FY24, although some were developed at the R&D scale. Having discussed about the work that we have done on our strategic, on the execution of our strategy, I would like to address a few questions regarding some topics that were raised by the shareholders. Number one, demand. So volume growth in FY24 indicates that the demand was robust. As discussed in the annual report, we saw a significant drop in API prices in India and ROW markets. As it happens in such a deflationary environment, we are observing a slightly subdued demand. Customers are currently buying limited quantities, driven primarily by expectation of further drop in API prices, which, unlike in a typical price rise cycle, where customers tend to hold stock in anticipation of price rises. So this deflationary scenario is having some temporary effect on the demand. But however, in the larger picture, as our APIs are in the chronic segment and the overall market demand and volume growth of these APIs should continue as per previous trend. Any setback that we are seeing in demand is only quite temporary. Price trends. Raw material and API prices have stabilized, albeit at a lower level than historical averages, and we do not anticipate any further significant drop in prices. However, there is uncertainty regarding the timing of a price rise cycle. We are getting mixed signals regarding the same, particularly from an important market like China. On the one hand, we are seeing the negative impact of Chinese overcapacity and high inventory on intermediate and API prices falling in India and the rest of the world. But on the other hand, we are seeing a lot of interest from Chinese API manufacturers for importing intermediates from India, including from us, which is an indication of growing cost of production within China. Whether it is a shutdown of plants or diversion of capacity or a dip in capex, one thing is for sure that the existing Chinese supply chain is getting disrupted, which can generate opportunities for Indian manufacturers. We are actively pursuing multiple opportunities to increase our intermediate exports to China, which can generate good business in the medium term. However, in these uncertain times, estimating when prices will start normalizing is very difficult to say. Number three, capacity. Depending on the products manufactured, the capacity in terms of metric tons can vary a lot. Hence, a better measure of capacity utilization would be equipment occupancy. Our current operating capacity based on equipment occupancy is approximately 60%. At full capacity and with higher value-added products and market mix, we can achieve a sizable increase in revenue with the same equipment. Since the fixed cost remains more or less the same, we should see a growth in EBITDA margins at higher capacity level utilization. However, the key to revenue growth in API is market access. So the approvals from Europe, Brazil, and China are key to reaching the full potential in API capacity utilization. However, in the meantime, our intermediate business is picking up both in domestic and export markets with ever more inquiries than we anticipated. The approval process for intermediates is shorter in time, and this may contribute to higher capacity utilization in the short to medium term. This uptick in intermediate business potential is a direct result of our backward integration strategy. Hence, we are inclined to direct our R&D focus on developing as many intermediates as APIs to leverage the opportunities that are present today. Competitive landscape. API in general has been highly competitive field, both from a domestic as well as foreign manufacturers. The current economic situations in consumer economies like US, EU, and India, as well as supplier economies like China, has made the situation all the more challenging. Not to mention all the geopolitical tension that has been affecting global markets. It is difficult to identify products with limited competitive intensity in such a highly crowded marketplace. Hence, from a product selection point of view, as a general rule, given that our equipment size and capacity, we look for product with high volume and moderately high prices. Except for metformin, which is a low value and high volume product, all of our latest developments have been relatively in the high volume, moderate price segment. CapEx. So looking ahead to FY25, we have outlined a low capital expenditure. We shall invest in CapEx to support debottlenecking of capacity, improving operational efficiency, and regulatory requirements. We do not intend to spend capital on increasing capacity, given that we have enough spare capacity. Now, looking forward, I will, going back to our strategy, I will outline our thought process on implementation of the same moving forward. Number one, R&D. We shall be increasing our depth in the cardio and diabetic segments while adding select products in central nervous system therapeutic area. However, as mentioned earlier, we will be focusing equally on intermediates as it allows us to penetrate the market in a relatively short period, contributing to higher capacity utilization and consequently better returns. Regulatory. In Europe and Brazil, our files have been in review for some time. By the end of FY25, we expect to be inspected by Brazil at least and by both Brazil and Europe at best. Particularly in Brazil, multiple clients have referred to our DMF in their formulation files with the regulator. Hence, we are expecting Brazil inspection sooner than that of the EU. However, inspection schedules of regulatory bodies are difficult to predict given the preferences and availability of inspectors. Forward looking to FY25, we shall be filing 2 more DMF in EU, Brazil, China, each and 1 in South Korea, bringing our total to 7 DMF filings in these key markets. The products that will be filed are amlodipine mesylate, S-amlodipine mesylate, telmisartan, losartan from the cardiovascular portfolio, ticagrelor and apixaban from the anti-platelet portfolio, and norfloxacin from the anti-infective portfolio. Finally, I will touch upon our formulation marketing division. As mentioned in the annual report, the company has optimized the number of headquarters in order to meet performance expectation. This move is aimed at focusing resources on more profitable and higher performing locations. The company's products in the chronic cardio and diabetic segments are highly competitive and are reaching critical mass in terms of repeat prescriptions. In addition, we have launched 2 new products in the acute pain management and antihistamine segment in FY24. Our target for FY24 is to launch 2 more products in the acute segment to enable us to reach break-even, and we are confident of achieving the same by Q4 FY25. In FY26, the FDF segment should be a profitable and integral part of our operations with regular performance monitoring to ensure that we meet our objectives for this segment. Finally, for FY25, our target is to maintain our API volume and margin growth in this tough environment. We do see some growth coming from intermediate segment. In spite of a loss-making first quarter, we are confident of ending the year with a profit on an annual basis. typically our first quarter tends to be more slower than the rest of the quarters. So, having said that, I would like to conclude my brief about the current and future of your company. I'm thankful for your time. We at your company, Smruti Organics, will always strive to deliver our best. Thank you.
Thank you, sir. So the results of votes cast through remote e-voting and e-voting at the AGM will be uploaded on the website of your company within 2 working days of the